All right, good morning, everyone, and welcome to Introduction to Real Estate Investing, Home Runs. This is lesson 4, and I'm going to go over lesson 4, give us an overview, and we're going to be digging into the weeds on case study number 2. In lesson 4, I think the biggest takeaway right now that I would encourage for this particular lesson is understand each real estate investment deal should be clearly defined in terms of what your investment objective of the deal is and your exit strategy and what benefit that you're getting from the transaction and from the deal. What are you trying to accomplish financially? What is this deal giving you? More importantly, and this is where a lot of investors lose half or more of the money or opportunity to make the money because they're not thinking in terms of the structure of the deal or the structure of the entity or how they're going to do the deal. And what happens is we just go out, we buy a piece of real estate, and then we do something, we hold it for a period of time, we sell it, and then we have capital gain, and we have all this tax exposure that's unnecessary. And that's where we dilute a lot of the profit and capital gain potential, and we create an overexposure to the tax situation by creating more taxable exposure. So lesson 4 is really going to be about the planning methodology. And remember, this particular course is 5 lessons. So we've got one more lesson at the end of the month that we're going to do, and then that will complete all 5 lessons for the Introduction to Real Estate Investing. The next course, which will be 5 lessons, we're going to get deep in the weeds on the financial metrics and the analysis, the cap rate, all of these different components that make up how we financially measure and evaluate a real estate investment opportunity. And so we're going to spend quite a bit of time in July and August moving forward in the second course to really understand how we're going to measure our financial performance. And you're going to see a distinct difference in what even a little bit of planning can do and how much money you're going to be able to keep, particularly with what we're going to learn today in lesson 4. So let's jump in and start with the overview of the lesson plan. This is a real estate purchase and flip with a short-term hold strategy. Short-term hold is going to be 1 to 3 years. Even though if it's more than 1 year, it's long-term capital gain. The holding period is less than 5 years. Let's just put it that way. So a short-term hold is any holding period of the real estate that is less than 5 years. In this particular case, the Perry Osea project, the holding period was about a 3-year holding period. We have the opportunity, the entity structure, the actual purchase, the analysis, and the breakdown of the transaction, and from start to finish, how that transaction flowed and how the capital gains and what a little bit of planning did to measure that, where we had absolutely no taxable income or gain. Moving forward, we have a summary of the entity structure. In this particular transaction, we're using a management corporation conduit that is a member of an LLC, where the LLC owns the property. along with myself and Susan. And so that formed a partnership for the LLC, and it gave us a great investment opportunity. We'll go over a little bit of the highlights of the purchase and negotiations, the summary of the analysis that we're going to review in some of the spreadsheet, and then the management structure of the corporation and how we were able to mitigate, a significant tax savings from this particular transaction. The learning objective, I'm just going to sort of quickly review this, is to review the various terms that we're going to be using and to define the types of property model, the entity of choice. Again, it's a corporate management conduit and an LLC that serves as a partnership. That's the entity structure. And then we're going to go into some detail on creating that management conduit review so that you can see that there's a reason why we have that for a partnership, because the LLC can disproportionately allocate the profits and losses. In other words, the LLC, the corporation could be a 10% member of the LLC, but get 90% of the profits and losses. And that's the uniqueness of a feature of the LLC, is the disproportionality rules. This particular transaction is pretty straightforward in that the property on our last lesson was on Mohawk, and that was the 5-year holding period, and we took a 4-unit and turned it into a 5-unit. We're still holding that property. Well, on the corner of Mohawk and 72nd Street, there was another property. It was a house, and it had an attached garage that was converted to a little studio, and then it had a detached garage, and then in the back it had an outbuilding and workshop. It was 2 parcels for 1 lot, and we purchased the property with the intention that we were going to go in and rehab it and flip it for a profit. We thought we would net somewhere between 50, maybe 75,000 net. When we got into the deal, the property was listed for $600,000. There were 2 competing offers ahead of us that one offered full price, 600. One offered a little bit less than full price, and then we were the 3rd in line by number. And our offer was $575,000. And the sellers took our offer because we guaranteed that it would be all cash with no conditions, and we would close escrow in 20 days or less. And the sellers were the children of the parent that was in the house that had to be put into a home because of dementia. So the children were motivated for the cash. And because they weren't going to be looking at all these conditions and 90-day escrow and blah, 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 it's close to the end of the year. We could close the escrow in time, an all cash deal, 20 days or less, no conditions of sale. It's a pretty attractive deal. And we had our agent who represented us sort of tell our story. Susan and I were investors in the neighborhood. We own the building next door. We've got an interest that we're looking at in another property 2 blocks over. And we own a home about 5 miles away, and we own another rental about 10 miles away on the beach over in Del Mar. And we've been here our whole life. In other words, we had our agent sort of tell our story, who we were as investors and as people. And our plans were to fix the property up and make it a nice home for somebody that wanted to buy their first home. That was our whole objective. I think the thing that motivated us getting the offer for 25 below market offer and less than the other two competing offers was the fact that it was an all cash, no financing, and no conditions. We're not going to ask you to do anything, fix anything, nothing. Here's the cash. We're ready to go. So we've got it for 575. We get our engineer involved. We knew that we could flip it, and we knew that if worst case scenario, if we wanted to do a little bit more, we could build a second unit and actually have like a duplex or a 2-on-1, and we would still come out pretty far ahead. So the risk for the deal was actually very minimal, if at all. We had very low risk on the property. So our same corporation that served as a management conduit on Mohawk also serves as a management conduit for Perry Osea. Perry Osea is a separate LLC that we set up for properties that are going to be short-term holds and flips. Mohawk is an LLC that we set up for property that we're going to buy and hold for a long period of time. So we've got two LLCs that do two different things. One management corporation, Susan and I own all of the stock of the corporation. And then the corporation, along with Susan and I, are managing members of each of the LLCs. So we create partnerships at the LLC level. So that's our entity structure and composition, and how we went into the deal and the basics of the transaction being all cash. Now we're going to go into the numbers. And what I'm doing here is I'm giving you the result of the financial data. In the first column, if we had done no planning, what those numbers would have looked like. And then the second column, what the result would look like with the planning that we did. We have a purchase price of $575 cash. We allocated $125 to land and $450,000 to the various buildings and improvements. We go down. We're closed escrow. We're working with our engineer and our architect. We go to the city. We talk to the city over the counter, and we say, look, if we wanted to build another unit, the 2-on-1, or add to this unit so we had 2 full rentals plus a little studio, would the city approve the permits, and what would the permit process be? That's kind of our question, because we wanted to start getting the engineering stuff and the environmental and do the soil test and all of that. Every deal that we buy, we have our survey company come out and do a survey. So we had this property surveyed, and the lot measures were off by 7.5 inches. So we got a new survey map and recorded that, and it allowed us to do a couple of other things in creating some opportunity. And the city came back and said, no, you can't add another unit or build a separate unit. The property qualifies where you could build 14 units on the property. So using the highest and best use approach value, we took the 14 units and we said, what is the land value if I had a lot that was a vacant lot and I could build 14 units? What would a developer or an investment group pay for the land per unit for that property? And depending upon zip code and a few other factors, that per door value of land came in to be somewhere between $80,000 and $100,000 per door. So in our particular case, this property is 5 minutes away from San Diego State University, going west. And if we were to go southwest in the other direction a little bit, we're 10 minutes away from National Steel and Shipbuilding and 32nd Street Naval Base. Two primary areas, because those are lots of consistent tenants that we're always looking for, good tenants. So a 14-unit building for a developer would be a very attractive deal. And we settled in at about $90,000 a door. We took the difference between the 80 at the bottom and the 100 at the top, and we said, look, we're going to split the difference, and we're going to ask for $90,000 a door times 14 doors. And that's going to be $1,250,000. We got a broker, a listing broker, and we listed the property. And in 5 days, we had a full price cash offer with a 30-day or less escrow for $1,250,000. Now, back up a little bit. In the course of the ownership, we held this property slightly under 3 years because it was in the cycle of COVID. We came out of COVID and it sold December of last year is when we closed escrow. But we went in and scraped the lot and knocked down all the buildings, did all the environmental clearance, and had a vacant lot with just dirt in a perfectly buildable lot. That investment and demo cost was about $53,000. So now we're into the property for $575,000 plus $53,000. So our basis is $628,000. That's what we've got in the deal. Now we've got a vacant lot that can build, a builder can build 14 units. And by the way, when those 14 units are built, they're going to be worth $575,000 per unit times 14 units. That property will have a market value of about $8.1 million and a development cost of about $5 million. So there's an upside of about $3.5 million profit for that builder. Now, I've built units before, but I've never built 14, and I didn't want to take the opportunity for me to learn how to build 14 units because that's a whole different animal. So now our basis is $628,000. The LLC sold the property, didn't even take a week, full cash offer for $1,250,000. And the four components that we're going to be measuring on performance of this investment was our tax savings, our highest and best use valuation, the appreciated value, not because of market conditions, but because highest and best use. The highest and best use of this property is not to have a single family house with a rental studio. The highest and best use of this property is to scrape it to the dirt. It's a level lot in a transportation corridor. The city's going to let us build, or let a builder build 14 units on it. That's the highest and best use. And now the only concern that we have is the capital gain mitigation. We're selling it for $1,250,000 with a basis of $628,000. We've got a big gain exposure. So let's look at that next analysis. If we had done no planning, we sell it for $1,250,000. We've got a cost basis on that side of $575,000, and we have a capital gain of $675,000 minus the cost of sale of $107,000. So we have a taxable profit of 567.5. Because we live in the Socialist Republic of California, federal and state combined taxes would be $270,130. So you take the 567 minus the 270, that's going to leave us slightly under 300,000 after dust settles. With the planning that we did, we had the same sale price of $1,250,000. Our cost basis was $628 because we had the demo cost. So now our capital gain is $622 minus our cost of sale $107.5. But now we're going to pay, the LLC is going to pay a management fee of $575 to the corporation. So the LLC partnership now has a tax loss of $60,500. The corporation now has income of $575,000. We have all of our original capital back. We give Susan a $250,000 salary. And because she has a defined benefit plan, the corporation can now make a contribution to her retirement plan of $210,000. Those are tax deductions for the corporation. So the corporation now only has taxable profit of $54,500, and I don't have to fund the defined benefit plan contribution until October of this year. So my total tax on everything is $8,175. So I saved $261,955. We took the 1.1 million of cash that we had left. That's our capital gain plus our original capital. We invested it into our stock portfolio account, TD Schwab, and we bought NVIDIA and we bought Amazon. I just sold our positions in NVIDIA and Amazon and made a $383,000 profit. And by the end of June, I'm going to buy them back and flip it again before the end of the year, and I'll double my profit again and make about $800,000 this year. So I'll have the $800,000 plus the $1 million back, almost doubling my money, and I still don't have any tax liability. What I'm suggesting is that if you're going to build wealth, you have to have the right structure. Because if you had done this as a solo investor, you'd have given up more than half in tax, and what little you had left would take all of the momentum out, and you wouldn't have the opportunity to take that $261,000 in tax savings and add it back to your capital and invest it while you're waiting for the next real estate deal. And that's the whole point of this course. That's the whole point of figuring out what the investment objective is for your investment. And I can't tell you how many times we look at a deal and we find that there's no objective. So the question in the chat is, so you bought and flipped Amazon stock and you don't have a tax liability? That's correct. Because we bought and flipped Amazon and NVIDIA, and we're going to buy and flip it again, those profits go into the salary, which we get a deduction for, and an additional defined benefit contribution for tax year 2024. So we'll put $200,000 in salary, $200,000 in defined benefit plan, eat up that $400,000, and I don't have to fund that till next year for tax year 2024. So we'll have no tax liability except for the FICA Medicare tax on the salary. We make a contribution, the salary, let's say, is $200,000 to $250,000, and up to $250,000, the retirement contribution under a defined benefit plan is 100% of the salary. This is not a defined contribution plan. Defined contribution are your SEP, your IRA, your SEP IRAs, all of those, where the contribution amount is defined by statute. This is a defined benefit, not a contribution. We're defining the benefit that Susan's going to get at retirement. And over the course of 4 or 5 years, taking the profits off of these, she will build up over $1 million in contributions. We'll get $1 million in write-off plus the salary write-off, and only have the FICA Medicare tax that we have to be concerned with. And those investments are growing in stocks like NVIDIA and Amazon, where we're flipping those stocks with, I think we were up 116% by the end of this last transaction. And that money's now sitting on the sideline waiting for the next tranche, so that when we take that through and buy that next real estate deal, we're going to have enough in depreciation to offset future gains for the next 2 years. That's because we set the structure up the right way to begin with, so that we had a corporation, LLC, for flipping property, which is separate and apart from the same corporation, but a different LLC for holding the property. Flips in one, holds in the other. Your tax structure will define how you're going to be taxed now and in the future on the property that you hold. The corporation doesn't own any property. The corporation is a managing member and owns interest in the LLC. The LLC owns the property. Now, if I want to get real clever and build up several properties under each LLC, and instead of doing an asset sale, do a stock sale and sell the shares of the LLC, I create some different opportunities for more sophisticated tax planning down the road. This is why multifamily is such a powerful investment when you have the right structure, because you can outperform any other asset class in terms of real estate. And if you stumble across a property that can give you a development opportunity like this, then you're going to be hitting home runs. We basically doubled our money twice and still don't have a tax exposure. And only because we've set the structure up in a way that we can take those profits in salary, $250,000, and then get a matching contribution for 100% retirement plan that's a defined benefit plan. Your contribution is 100% of your salary up to, I believe the new threshold limit is $270,000. Now think about it. You take a salary for $270 and you have a matching contribution of $270 for your defined benefit. That's $540,000 in deduction that you get. And the tax savings on $540,000 is about $210,000. So basically, the IRS is paying for about half of your retirement contribution with the tax savings. Why wouldn't I do that? And the whole purpose and the whole point is to have the right structure. But before you do that, before you close escrow on a property, what is your investment objective? So in our final lesson, in lesson 5, we're going to go back over the different investment objectives for real estate investing, because once you have your investment objective defined, then you're going to know the kind of structure, entity structure, that is going to be best suited for that investment objective. And if you don't have that set up, you will know that pretty quick. You can then do what we call reorganization planning and reorganize so that it is set up the right way. And that's very simple to do. You need the bylaws and the operating agreements, but basically you go through the process and you create that structure or reorganize your holdings so that they meet the threshold test of that structure. So when you take the analysis and you look at the tax savings on this particular real estate transaction, as soon as that capital gets to 2.4 million, along with what we've got in the Mohawk, and when we start harvesting some of the Bitcoin, we're going to have enough to buy that next property, about an 8 to 10 unit building with no debt, with that cash flow and no tax for the first 5 years because of the depreciation using cost segregation. So all we're doing is taking the profits and parlaying them and getting the next building. I'm not worried about capital gain and getting forced into doing a 1031 because I've got too much gain exposure, because I've mitigated all of my gain by having a management conduit as a member of an LLC. The LLC, as you can see here, had no tax. We had a loss. That transaction lost $60,500 because we had to pay a management fee according to the operating agreement, 90%, a little bit more than 90%, of $575,000 to the corporation. That's in the operating agreement. We had to pay it. So that created a financial loss. So that partnership, when it files the return for 2023, it's going to report a loss. That loss is going to go on our personal return. That's going to be driving some of that tax savings. The corporation's not going to have any taxable income except for that $54,500. And the tax on that is $8,175. Well, $15,000 estimated tax payment, I'll have a refund. But I got all the cash. And in the meantime, the cash kept working and it made more money. Go back and look around December, I think 11th or 12th. Go back and look at what Amazon and NVIDIA were selling for, because we put $1.1 million into both of those and then just flipped them in just here recently in the first part of June. Now we're sitting on that cash and we're going to do it again because NVIDIA pulled back a little bit and Amazon pulled back a little bit. We're going to flip it again. Peel those profits off back into the corporation, bump up the salary for 2024 and the defined benefit plan, and I still have no tax. And every time I do this, I'm getting more because I'm not paying $261,955 in tax. I'm keeping all of that because the structure is allowing me to keep it. This is an LLC that has a 2 to 3 year holding and flipping strategy. Mohawk is a long-term hold, 5 years or more. So different character, different composition, different tax objectives, and still no tax. Let's recap. The tax savings on this kind of transaction comes down to your management fee and your management agreement between the LLC and the corporation, your compensation analysis and salary that has to be actually defined, your defined benefit plan, that's pretty easy to put together, and then the actual contribution. I don't have to fund the defined benefit plan contribution until the tax return that it's on extension gets filed in October of this year. But I got the deduction for last year, and I don't have to fund it until this year. For 2024, I'll get the deduction this year, but I don't have to fund for the 2024 until October of next year. What a great deal. I still get the cash to use, and it keeps making money, and I'm not paying any tax, and I don't have to fund the deduction until next year. The second thing that we look at is the increased value or profit. This is not a value based on appreciated value. This is a value that came from highest and best use analysis. The highest and best use of that corner lot is not to rehab that house and that studio and try to build another unit. The highest and best use was to bring in a bulldozer and scrape the lot down to the dirt and get it ready so a developer could build 14 units on it. That's the highest and best use. And we got $90,000 a door for 14 doors that we didn't even have to build. We had 600,000 and change in it, and we got $1,250,000 all cash in 5 days. So our cost per door, the low is 80, the high was 100. We said, let's split the difference and take 90. That's the value, because a developer gobbled that property right up. They'll be breaking ground probably later this summer. We weren't that concerned with appreciated value, but market conditions, because San Diego is one of those areas where we just have a big shortage. And I can tell you that the per door cost now 6 months later is 120 to 140. If we'd have just held it another 6 months, we'd have got another 20%. We wanted to close it before the end of the year last year because we had other tax planning. So difference between a pig and a hog: pigs you eat and hogs you slaughter. We didn't want to be a hog. Market conditions were in our favor. They're still in our favor. Market comps still in our favor. It didn't affect our price because we knew what the per door price that developers are paying because there's such a shortage. Property enhancements, really, we had a set of preliminary plans and engineering and soil and a resurvey, but that was all part of our scraping the lot cost. And those were enhancements that we gave to the new buyer because they saved a little bit of money. And that was a convincing and compelling argument because we'd already done the homework. They were not going to have to worry about going to the city because we'd already greased those skids for them in our preliminary package. And that wasn't, I don't think that amounted to more than $3,000 or $4,000, and that was built into our demo cost. So it's all gain. It's all gain. And if we hadn't done any of that, we'd have given more than half of that up in taxes, almost $300,000 in tax. The value of a defined benefit plan is that it's not a defined contribution. It's 100% of your salary up to $270,000. That's how much you can contribute to your plan. You get the deduction this year, and you don't have to fund that contribution until the extension period on your return next year. Defined contribution is not going to give you the kind of benefit tax-wise that a defined benefit plan. So you make that part of your corporate strategy to have the salary and the defined benefit plan. Then you can use the self-directed rules, and maybe your defined benefit plan can invest in the real estate deal the next time. That's kind of what we're looking at doing now once we build that up to another $1 million in value. We're still going to do real estate, but maybe we're going to have the defined benefit plan do the real estate. You need to have compensation and salary analysis, because if it gets challenged by the IRS, you don't want to have those problems. As a valuation analyst, I do salary comparisons and I do salary analysis so I can help at least guide that process and do that study so that you know you're in line with what you can do and maximizing that opportunity. Again, defined benefit versus defined contribution. Everybody else is investing in 401k and IRA and SEP IRA. No, you don't get any momentum for those. The defined contribution is fine to start out, but accumulating wealth, you want defined benefit because it's 100% of your salary is the contribution limit up to $270,000. So that means you take a salary for $270 and you take a deduction for the contribution to the retirement plan for $270. Now your corporation gets a $540,000 deduction, and you get the benefit of saving over $230,000 in tax. The IRS is basically funding about half of your contribution with the tax savings. You take that savings and continue to accumulate that and invest that in stock or invest that in real estate. That's how you build wealth and not pay tax on it legally. Let's look at the structure, its composition. The corporation, you're the shareholder who owns the stock of the corporation, or you and your spouse. You have a salary, you have a defined benefit plan, and you have a management agreement so that you get a management fee from the LLC. Then you have an LLC, a specific purpose LLC. The corporation and you, or the corporation and you and your spouse, own the LLC as managing members. Corporation owns 10%. You and the spouse own the other 90%. Corporation, because of the disproportionality allocation rules, owns 10% of the LLC, but gets 90 or 95% of the profits and losses. Or in this case, a $575,000 management fee. We report that as income on the corporate return, but we get a deduction greater than the 575 because we have salary and defined benefit contribution. We still have all the cash because we don't have to fund it until October of this year. The LLC owns the property. So the LLC sells the property, pays the 90% profit to the corporation. The LLC owns the property. The demo project is done at the LLC. The LLC pulls the permits, gets the environmental clearance, does all of the heavy lifting. Could have sold the shares of the LLC, or the LLC could have sold the real estate. Either one. We're going to keep the LLC and sell the real estate. The corporation is owned by the investor, you, and the LLC is owned by the investor and the corporation, creating a partnership. The rental property, or in this case, the demo property, is owned by the LLC. All we need is to make sure that our bylaws are congruent. The LLC operating agreement has got all the tax provisions and tax elections, that we have a properly executed management agreement between the corporation and the LLC. We have a lease agreement between the LLC and any tenant if we were going to rent it out before we demoed. We're going to determine our holding period. In this particular case, it was going to be less than 5-year holding period. Then we have an asset class and asset segregation between land and building. At the end of the day, it was all land because we scraped the lot. So everything goes to the basis of land. There's no limit on the amount of the management fee. In our case, it was 93% of all profits and losses. So we took that profit times 93%, and it worked out to $575,000. And it just turns out that we needed just about that amount to fund the salary and the defined benefit plan next year, which is 2024, October of this year is when we have to make that contribution. But in the meantime, that money is sitting in a stock account in NVIDIA and Amazon that we just flipped, and we're going to flip it again. So by the time we flip that again, the contribution is going to come from the profits of the stock. We're going to fund it, but then we have enough to fund for 2024. So we're not going to have any tax on the capital gains in the stock for 2024 because we're going to do the same thing with those gains on the stock. Once you have the model set up, life gets very easy. It's just rinse and repeat, doing the same model, whether it's real estate or stock. The point is, you've got the structure that allows you to accumulate and build the wealth, and you can do it a lot faster when you're not having to pay $261,000 in tax. I think that was the number. Let's go back and look. Yeah, $261,955. The moral of the story is one corporation is the managing member, in our particular case, of 2 different LLCs. One LLC is a long-term holding real estate LLC, and that corporation serves as a management conduit. The other LLC is a flip strategy, short term, which is less than 5 years, where we're going to buy a piece of real estate and we're not going to hold it for more than 5 years. We're going to flip it by either demoing it, scraping everything down to the dirt and selling it to a developer, or we're going to buy it and rehab it, like a 3-unit that we looked at recently. We could get it for 40% under market because it needs some work, but it doesn't need as much work as they think it needs. And there's probably a good margin of profit. So we're going to sit on the sideline and watch that a little bit. When you build up the amount that you can do in a transaction, you start looking at how you can be your own bank instead of having to go use a bank. And that's kind of where we're trying to figure out what's the best model. We'll talk about that in the next course, because you might want to have an LLC corporate setup where you have a lending opportunity, where that is what that LLC does, is it loans you money, or maybe it loans other people money. It's in the lending side of it. And there's some real tax advantages to having that structure set up that way. So just to recap, basically, we took a property where our total investment was 628. We ended up after cost with about $1.1 million and change. We've already turned part of that into nearly $400,000 in profits in the stock. We still have all of the capital. For 2023, we saved $261,000 in tax. By the time we settle the dust for 2024, we'll probably save another $300,000 in tax for 2024. And we don't have to fund that next contribution until October of 2025. Only because we have the entity structure set up the right way to begin with. And this is what I want to encourage. If you don't know if your structure is set up correctly, the way to find out is, what is your investment objective on the real estate that you own or the stock that you own? And if you don't have that investment objective defined, then it's probably pretty certain that your entity structure is not congruent. That's our starting point. So we would want to do a review and an analysis of that structure and composition. We would want to identify any inefficiencies or weakness so that we could look at either reorganization planning or structural planning to get it into the position so that you can take advantage of that. Taxes are not going down, they're going up. And what we have to look at is, what are the opportunities, particularly in real estate, because multifamily continues to contract. There's less and less of it. And so demand continues to grow while supply continues to contract. Relative to those two, supply and demand, price is going to continue to escalate. And I don't see that, or any other expert doesn't see that changing in the foreseeable next 5 to 8 years. It's only going to be more. Multifamily sweet spot is 2 to 8 units. That is the greatest opportunity for the least amount of risk, almost in every case. And being able to do that financial valuation, not an appraisal, but a valuation analysis, is critical in understanding what your financial opportunities really are. All right, with that, I'll open up. We've got looks like about 8 or 10 minutes left here. I'll open up for any questions that anybody might have, and happy to answer some questions. Hopefully,
James,
some fun.
I got a quick question.
Go ahead.
Well, at the beginning of this lesson, you were talking about originally trying to buy that first, that one property you were talking about for to try to maybe add another unit or whatever. Do you always keep in the back of your mind scraping and just selling it as a lot, or did that just happen organically? Okay, gotcha.
No, we
So that's
always keep that in mind.
gotcha. Okay, because because it almost seemed like it was just dumb luck, but I guess it wasn't because you always have that as a thing and part of what you're looking at a property for in the first place. Okay, got it.
Yeah, it really isn't. The only reason that scraping the lot and demo cost was 53,000 is California is a little bit crazy about the environmental impacts, and so you got to do a couple of extra things that maybe
Sure.
you don't have to do in other states. But there was a lot of other things that we built into that, like resurveying the lot, getting a new survey and a new map filed, getting the pre-permitting process with the city out of the way, and some preliminary drawings or some concept drawings and engineering and soil test. All of that was part of that. If we hadn't done that, we'd have been able to scrape the lot for half of that. And we, but because we did that, we were able to get and not have to negotiate. We were able to get $90,000 a door times 14 doors. They didn't even question it.
Gotcha.
Did not even question. We knew the low was 80, the high was 100. We split the difference, said, look, we're 5 minutes from San Diego State.
Right.
You do 90.
Sure.
$1,250,000 cash. It was listed for 5 days. We got a full cash offer and we closed escrow in, I think, 22 days.
Love it. Awesome.
It was great.
Cool.
Any other questions?
Hey, James, this is Steven. So I noticed, how you doing? So I noticed that on the management fee, right, where you had the 575. So my question is there like a limit as to what that management fee can be?
Nope.
There's not. Okay.
Because it's all ordinary income.
Okay.
So the LLC is a separate entity partnership. If it had paid a $700,000 management fee, the LLC would have got a deduction and we would have had a $260,000 loss. The corporation would have had $700,000 of income. Then the question is, can we justify, how much salary can we justify without the IRS trying to say that's an unreasonable high or unreasonable low amount of salary? Because we know that the defined benefit plan is going to be equal to the salary up to $270,000.
Got it.
And so we start with the end in mind and reverse engineer and work back with those numbers. And frankly, the big benefit is I got the deduction for 2023 and I don't have to fund the defined benefit plan contribution until October of this year. I get to use that money in the stock market and keep growing it. And I don't have to fund that defined benefit plan contribution until October 15th of this year when the return is due on extension.
Thank you, sir.
Yep, you bet. The power of having the right structure to complement the investment objective of the asset that you've invested in is critical. The second is the exit strategy. How do you get out of the transaction with the highest amount of gain and profit and the lowest amount of tax exposure? And that's the composition analysis. That part can save you literally hundreds of thousands of dollars if it's done correctly. And so what you want to do is you want to look at every asset group that you're invested in, and you want to do that analysis so that if you do need a little bit of tweaking or reorganization planning, do it now before you get too deep into your next transaction. The savings will pay for your next deal. I mean, it's just crazy how much momentum you can get after one or two transactions. It's so powerful. This is what wealthy people do all day long. This is why they're wealthy. Not rich, they're wealthy. They're building legacy wealth. All right. Any other questions?